Good morning, ladies and gentlemen. Welcome to the Diverse Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. Launched 14 years ago in April 2011 and managed since then by Gervais Williams, together with Martin Turner, the Diverse Income Trust was set up with the twin objectives of an attractive and growing level of dividends coupled with capital growth over the long term. Today, both Gervais and Claire Long, who is the head of investment trusts at Premier Miton, will give investors a brief overview of the trust, and we'll then move into a Q&A session at the end. So without further ado, I would now like to hand you over to the team from Premier Miton. Claire, good morning.
Good morning. Thank you. And thank you everybody for joining us. If I may first start just by drawing your attention to this important information slide. And as Jake said, I'm here with Gervais today to talk about the Diverse Income Trust. Martin Turner, also the co-manager, unfortunately not able to attend today. So, Gervais, as Jake set out at the beginning, the objective for the trust, could you start by summarising your investment approach in the context of the trust's objective? And what, in other words, were you and Martin aiming to achieve for investors in setting up the trust?
Yeah, I mean, longer term, the key issue is we're here to generate an attractive return for investors. An attractive return is a return which is hopefully outperforming other funds, outperforming other indices. And ultimately, over the longer term, there's only two things which really make a big difference to your investment return: what your initial yield is, how much that is, and most particularly how it changes over time. Irrespective of what portfolio you invest in, ultimately that's the key driver. So we like to think that if we set up a fund which actually had quite an attractive yield at issue, but more importantly, which grew that dividend yield better than most others, then that would drag capital up. You get the capital appreciation, you get the income, you get the compounded income over time. Ultimately, we feel that that would deliver an attractive return if we succeed in meeting those objectives.
You've acknowledged that the trust has had a difficult patch for a couple of years, but that more recently it started to outperform once more. We may come back to this in more detail, but could you briefly explain the reasons for this?
Yeah, I mean, what you're looking at there is specifically the total return of the fund relative to the total return, perhaps of the Deutsche All-Share Index. Specifically, what's interesting is it has outperformed since issue, but most particularly that period between, say, May 2021 and perhaps mid-2023, the share prices of the companies in the portfolio came down. Now, although it was difficult and disappointing for clients that we didn't do as well as usual in terms of that return, actually, I would slightly dispute that it was a poor period, because actually the income from the funds was doing perfectly well. The income grew beautifully. And so from that point of view, the companies were doing everything we wanted to. The share prices were doing everything we wanted to. And so what actually happened was the actual share price of the trust came down, the income went up, and so the yield on the fund actually continued to improve.
Yes.
So in a way, all that's happened is we've seen that pressure from local sellers. We've seen institutional sellers coming out of the UK to invest in the very strong returns we've seen in the US, has actually held back share prices artificially, in our view. And now we're getting a bit of a period of catch up, and hopefully not just a bit of catch up, but actually longer term, we'd like to think that these valuations are far too low, and actually there's much greater opportunity going forward.
Okay, well, we'll come back and talk about a bit more about income in a moment, but perhaps let's just turn to a bit more detail on the trust's strategy. What do you see as the benefits of the multi-cap strategy, and how does that help to differentiate the Diverse Income Trust from other UK-focused investment trusts?
Yeah, I mean, a lot of equity income funds generate good income. They generate income growth over time. Our job isn't just to generate good income, but to hopefully generate income growth, which is better than most of the others. And therefore, we tend to invest across a much wider investment universe. Specifically, that includes many of the areas which are not so easy. People worry about some of the complicated financials. They worry about some of the mining stocks. There's some of the stocks which are sort of complicated in terms of, is the energy price going to go up and down and that kind of thing. So there's a much wider range of companies, but much more importantly, there's a much wide range of business models. There's some younger businesses with less mature businesses. There's some global companies. There's some local companies. There's some which are, just about to start paying dividends, and there's some which have been paying for dividends many years, which aren't very particularly as happily. So it's that full range of companies, which ultimately means that when we get unexpected events, that most particularly the trust is less affected by that. It's got that diversity of holdings there. But most particularly, what you can see in this chart is actually the mix of the holdings is very different from perhaps what might be mainstream for many of the other funds, where they're really dominated by the large mid-sized companies. And you can see in this case, in this chart, that the pinky area is covering the larger end of companies. And we do have many of the companies, and they do grow dividends very happily, and we're very happy to have them in the portfolio. But in contrast to many of the other trusts, you can see the alternative markets, that's the AIM-listed companies. There's about a third of the fund in the AIM-listed companies, and about a third of the company in what's defined as small companies. These are typically companies at the bottom end of the range of market caps. And these are often companies which are immature. Some of them aren't paying dividends. Some of them are about to pay dividends. Some of them are growing the dividends beautifully, quite rapidly. And it's that great range of opportunity which we get really excited about. So we can grow the dividends for the trust better than most others.
Yes, I see. And in terms of the numbers of holdings, I mean, I think I'm right in saying the portfolio currently comprises around about 100 holdings. May seem like quite a long list, but this is also a cornerstone of your investment approach.
Yes, I mean, specifically, quite a few of the companies we invest in aren't that large at the time we invest in, so we can't necessarily get a very large holding. That's not a problem. If it's going up a long way, it's generating great income, we don't mind. But most particularly, actually, what's been interesting over recent years is as we saw the valuations coming down, the share prices coming down, that was probably most concentrated amongst small companies. UK mainstream companies didn't perform particularly well relative to international investors, but most particularly the smaller companies became much cheaper. And what we've seen over recent years is actually even the companies which have succeeded, their share prices, their valuations haven't moved up as much as we expect. And so what's actually happened is we've seen a slight concentration of the portfolio. So when you look at the whole largest holding, Galliford Try, for example, that's a much larger holding. Normally, we would expect that share price to risen much further, the valuation to increase as new investors came in, and that just hasn't happened. And so actually it's standing on a slightly lower valuation than we want, so we've held it for longer. And most particularly, in this case, it's just actually announced its figures actually yesterday, and it increased its dividend by 37% in final dividend. Lovely. We like companies which are already paying good dividend yields, which actually grow their dividends by such amount. And it would have been a shame to actually have taken profits too early. So there's been a concentration of portfolios, and that could go further. In other words, we could have 80 or even 90 holdings, something like that. It's not that we don't love many of the smaller holdings, but actually some of the companies, when we do get a winning holding, we're probably holding it a little longer than we have.
Yes, I see. So coming back to income and dividends, the dividends paid by the trust, as you can see on the slide there, have grown consistently since it was launched, and that's a key priority. Can you explain a bit more about how you balance the need for income with the search for capital growth?
Yes, I think what I would say is I think we actually think that actually it's not quite one or the other. A company which generates not income, but income growth, which grows very rapidly, hopefully we'll see its share price appreciate rapidly as well. So it's not quite a case of, we have to go for second best because it's an income stock. We think we can get very attractive returns in income, particularly some of the less well understood companies, particularly recently with some of the valuations of some of the smaller income stocks being very overlooked. So we think, coming back to it, there's a bit of both, but ultimately, if you assume that the income on the fund, the yield on the fund is sustained over time, then any growth of the income reflects capital appreciation. So if you've got it in a 5% yield or whatever it is, it's just a little under at the moment, but most particularly, if it was on a yield like that, and it was on the same yield next year and the year after, then any income growth would be reflected in capital growth. And then obviously you get the yield and the income compounding over time. So that's how we think of. We think both work together.
Yes, and I think this is shown on the next slide, and highlighting there the balance between income and capital.
Yeah, I mean, I think this is actually a slightly more important slide than it looks. It looks quite dull, actually. We've got quite a lot of income, which has generated the income return, and there's been a capital appreciation along the way. But actually, there's two types of ways of making long-term returns. There's two flavors, if you can call it. And really, over recent years, I'm talking the last 10 or 20 years, many investors have come really very focused in on the ability to buy a lowly valued company before it becomes popular, as its share price goes up, taking share. And that's very transactionally led. It's actually done very well when stock markets have been going up and valuations going up, and many of the largest companies in the US have been performing so strongly, and that's great. But actually, it's quite a vulnerable strategy in that if your share prices don't go up, or indeed if there's a setback in the markets because, say President Trump does something unexpected, then actually you're quite vulnerable. So actually, we believe there's going to be a slight change towards the second way of making money, which is investing in a company which has good income, and that income goes up over time. Now, first of all, you get that income coming in regularly, and if you want to, you can reinvest and buy some further assets. Obviously, you can use it for income, but more importantly, actually, it's a much more stable way of return. If the stock market does fly around a lot, actually, you're still getting your income.
Yes.
And so the income, you don't have to sell shares to gain income. So actually, and we think at the margin, Trump is opening up sort of a degree of uncertainty about the future. And we are now seeing just around the edges, a little bit of institutional move away from perhaps the capital growth, some buy and sell strategies into income. And that's really why I think we're starting to see some of the UK and some of the European markets starting to happen.
Yes. Okay, great. So let's just move on to your stock selection process. Obviously, your universe is potentially quite sizable. So I imagine investors would like to hear a bit more about how you go about selecting stocks.
Well, the key issue is that when we meet companies, it's not just about what the valuation is now, but most particularly about the cash surplus they're generating, but most particularly where it's going. And you can invest in some companies which are, whilst they don't have any yield now, might be generating a very substantial cash surplus in the future. On the other hand, you can meet other companies which are growing quite happily. So coming back to it, we do need turnover growth. Nearly all companies are generating turnover growth. It's not a difficult thing to mean, but you need more pound notes coming in the front door, actually, to obviously generate that income and grow that income over time. So we regard this as a traffic light. Good and growing income is reliant on good and growing turnover. But alongside, and probably equally important, possibly even more importantly, the company itself needs to generate an attractive profit margin. And if you've got a company which is growing its turnover, but the profit margin is coming under pressure, then that point ultimately means you probably don't generate as much cash as you'd like. So coming back to it, we need a company which is not just rising in terms of turnover, but sales, but most particularly has the ability to charge a price through difficult times, which is relatively resilient. And when we come to that, it's ultimately customer service is kind of important. And Martin and I are very focused on that. The third element is that many of the companies we meet, have been successful. Many of the management teams have been successful. And the danger with success sometimes is if you have a series of success, you become a little bit overconfident. And we do meet some management teams who are overconfident. And that's actually a negative for us. We want management teams who are, if anything, a little cautious rather than overconfident. That means that if anything unexpected happens, hopefully we're safe in terms of, the dividend isn't cut. But most particularly, it means also perhaps the management teams aren't going to overstretch and catch it out and then find an unexpected event catches them out. Again, not all the companies progress as we expect. Global events turn out differently to what we expect. So again, we like companies which are relatively safe in the financial department. What we really mean by that is they have less debt than most others, or possibly net cash. And that means when they succeed, they don't just generate surplus cash. They don't need to repay an awful lot of debt. So that dividend growth comes through really strongly. And then I'm afraid Martin and I are quite mean on valuations. We're not keen to pay up. Now, don't get me wrong. There's some wonderful companies out there which have continued to outperform brilliantly. Unfortunately, we don't hold those, not because they're bad companies, but if they do get caught out, they're more vulnerable. Yeah. We prefer to look at the companies which are less well understood, perhaps a little uncomfortable, perhaps they're in the financial sector, and the trust has quite a big financial weighting, and therefore, actually, when they succeed, that dividend growth captures people out in terms of the upside. And so when you come to it, some recent examples, perhaps a holding AO.com, which is AO World in the stock market terms. This company was only 1% of the fund back in October. Its share price has gone down since October, but the share price, we've built a new holding. It's gone up to 1.5%. We think it's a terrific company. We think it's doing everything right. It's got the 5-star club. It's made an acquisition, Music Magpie. We think that it's going to be outpacing many of its competition. It's an unusual company because it's in the consumer sector. But from the point of view of those green lights, we think every single one of those green lights is on. These are sell disciplines too. If we get a red light, we single red lights to sell. Falling turnover, margin pressure, overconfident management team, financial headroom, the compromise or valuation. But generally, these are the kind of companies coming through in the portfolio.
Yes, I see. And obviously, you and Martin have worked together for quite a few years now. Do you have complementary skills as co-managers? Do you sometimes disagree on which stocks you should buy? What do you do then?
Yeah, it's interesting. Actually, what's interesting about the process is it's universal. And what's even more remarkable, because Martin and I were different individuals, we're not clones of each other, but when we meet with companies, nearly always, even if we're meeting individually, we come out with the same view. So actually, if you stick to the process and get the same answer, it means that therefore we can be twice as effective across them. Of course, occasionally we might argue about whether something's an orange or green. And actually, there's so many to choose from. It doesn't matter.
Yes.
We don't need to worry about that. We're just going to move on.
Yes.
Let's find something we agree on, which is nearly all the others.
Okay.
Yeah.
Okay.
Yeah.
And you mentioned meeting company management there. I know that's something you attribute great importance to. And I think you see it as a additional differentiating factor to many of your peers. Can you say a bit more there?
Absolutely. I mean, we're very lucky in that many of the senior management teams of all these companies willing to come and see us. We tend to have a very strong reputation. We've got a small cap strategy as well, which means that many of the younger businesses are already meeting us because we're investing in small companies. And as they mature, as they move to income, of course, we're ready to invest in them. Ultimately, there's quite a lot of placings we get involved in. But ultimately, the really huge advantage of seeing so many companies is we get each meeting gives us a little sense check on different parts of the market. So we may not be invested in this company, but it might have an influence on that company. They might be customers, they might be servicing companies, they may have problems which are going to be replicated in other companies. And specifically, when we meet companies, it's not just the opportunity to meet companies, we can offer them ways in which they can probably modify what they're doing, not just to obviously be a bit more successful, but actually bring other investors in, help their valuation move up. So it's quite a two-way thing. It's not just about what the company tells us. We give lots of thoughts and ideas about where we are, and it's that mix, I think, which really helps us to then not just succeed, but actually hopefully get involved in some companies at relatively early stages, which can then generate not just attractive returns, but unusually strong returns.
Yes. Okay, great. So before we turn to investor questions, perhaps a few thoughts from you about why you are upbeat for the prospects for the UK stock market from here. Obviously, there's a lot going on globally, particularly as you've said with Trump. Why are you so upbeat on the prospects for the UK market?
I mean, what's happened really is that globalization has been with us for 30 plus years. And I think that's led to institutional capital to really crowd into the US market, to really crowd into many of those very largest technology company holdings. And I think that's fundamentally unstable. In 3, 5, 10 years, sometime, that pattern's not been there. It's too concentrated in terms of stock specific risk. It's too concentrated in terms of sector risks. And most particularly, it's vulnerable in that, these companies are standing on very elevated valuations. And if there is unexpected disappointments in the future, these valuations can come down. The problem with technology companies is when they disappoint, they can disappoint in size. Go back to .coms, Nokia. Where is it now? It's still alive and it's fine. They're talking about putting all that mast on the moon today. But the point is actually that it's down 90%. So actually, we think that the current position is unstable. And we've got Trump injecting additional instability. And coming back to the two ways of making money, good and growing income, but most particularly capital growth, we think there's too many institutional capital growth strategies. And that at the margin, they'll take capital out of those. Where do they go? Good and growing income. Lots of UK companies, lots of European companies, UK and European companies have started to outperform. Only at the big cap end, we haven't seen the small caps come. We think basic globalization is all been about bigness. They've had the scale, they've had the opportunity to sell around the world. We think actually protectionism, nationalism is going to be much more about smallness. And the UK actually has not just a strong, but an outstanding, probably one of the world leading markets in smallness. So we've got good and growing income, but I think that's the UK market's going to outperform. Particularly my view is that, like we saw with the 65 to 85 period, that's not about the UK economy, that's not about government, it's not about whether we do or don't have a problem with the oil price or some unexpected geopolitical event. That's ultimately down to the fact that good and growing income is going to become more popular. It's undervalued in the UK, but much more importantly, we think small caps are going to become important. And so the multi-cap nature of this portfolio, the ability to invest in mainstream companies, but to get some of those undervalued companies, not just to succeed, but succeed in much greater scale than everyone thinks, means that actually the portfolio is superbly positioned in our view. I'm more bullish now than I've been for 30 years. And that's not to say I think stock markets will go uneventful, things will turn out fine. I think it'll be an uncertain period. But I think companies will get stronger, strong companies will get stronger, weak will get wiped out. And we'd like to think we're backing many of those strong companies.
Okay. Thank you, Gervase. And we'll stop there from a presentation point of view and questions.
Perfect. Gervase, Claire, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, as you can see there, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so. And if I pick up from you at the end, that'd be great. Thank you.
Thank you, Jake. Okay, we've got a few questions coming here. There's a question about whether the trust still has the facility to short in the event of a market decline, which was an option that you used at the start of COVID.
Yes, the trust has never had the ability to short. What we mean by that is to sell companies we don't have. We've never had that opportunity. But what we have had in the past is a bit like car insurance. It's called a FTSE 100 put option, and it acts a bit like a car insurance. You know, if the markets go down a bit like your car insurance, you can't claim. But once you get beyond a certain level, it starts to claim. So coming back to what we have had in the past, a bit like a car insurance, it costs cash. So if you don't insure, I mean, if you don't get a claim, so we have had it in the past. In March 2020, we had a option in the portfolio. The great advantage of that is, although it doesn't cover 100% of the portfolio, as the portfolio goes down, many of the stocks go down. But this is uncorrelated; it goes up, and so the opportunity is for that to take profits and move on. We have had it at times. Actually, we don't have it at the moment. Don't get me wrong. I think that the world's uncertain out there. The UK could outperform. Actually, in a way, the trust has an added advantage over, say, a unitised vehicle. In that, if we do get a setback like we saw in March 2020, then the trust, after the market's fallen, can actually borrow money.
Yes.
And see all that upside. So it's got more recovery potential. So at the moment we don't have a put option in there. Actually, of course, it may be the markets don't come down anyway. But anyway, at the moment, just to answer the question.
Yeah. Okay, fine. And then there's another question. Can you explain the purpose behind and the benefits of the annual redemption facility to investors? That's something.
Okay. Yes, we did mention
unusual.
That. Yeah. So the nature of the trust is that we think it's going to generate very attractive returns long term. The problem with investment trusts in general is that sometimes when there's more exciting things elsewhere and local investors are selling, you can sometimes see the share price not keep up with the NAV, but that's the net asset value, holds up or whatever. You can sometimes see the share price move to 15, 20, 25, 30% discounts, something awful. And we really think that's that's not a nice thing for our shareholders. So much rather than, if you are needing to sell and there isn't enough buyers in the market, then every year the trust has the opportunity at the director's discretion for you to say, actually, we do need to exit. We're not happy with the market price. And you can send in a redemption form. And that's in the middle of the year. This year, I think it's July. So coming back to that, you send in your form. And by doing so, effectively, then if there's a number of investors selling, perhaps 5% of the clients want to come out, then 5% of the portfolio holdings is put into a redemption pool. We sell that on your behalf, and that cash is returned to you. Of course, there are some costs, and the market may have moved in the meantime, so it's not precisely what you would get. But anyway, it's a good way of clearing sellers. The reason why that's so important is that, one, the share price tends to trade very closely to NAV, sometimes premium, sometimes discount, small discount at the moment, it can be premium, but much, much more important, ultimately, the trust itself probably is unlikely to go to a big discount.
Yes.
And so ultimately, we don't find that actually shareholders have that extra worry of the share prices moving to this big discount or being a less discount. It's much more closely related to the share price.
And it's quite an unusual facility, I think.
It is very unusual. Obviously, to some extent, we're allowing all investors to actually just exit tomorrow or the next redemption date. So we have great confidence in the strategy, and hopefully that's reflected in our shareholder base. If it isn't, then unfortunately we can lose out badly.
Yes, understood.
Yeah.
Okay, we've got a couple of questions about dividends here. Firstly, in relation to the increase in the total annual dividend over the past few years and the policy for future increases. Well, that is ultimately a board driven decision. Any comment to make there?
Well, first of all, the trust itself pays a dividend from revenue per share.
Yeah.
And the revenue per share has generally risen nicely since we set the trust up in April 2011. There was, of course, a setback in May 2020.
Yeah.
Obviously, a lot of companies with COVID had cut their dividends. So the revenue per share actually fell in that year. But the board was able to look through and recognise that actually a lot of companies were already, by the time they make a decision, starting to actually increase the dividend or pay the dividends they passed. So coming back to it, the board didn't just see into the year end in May 2020 that the trust was well positioned for the future, but actually they had revenue reserves.
Yes.
They'd saved up some of the revenue for the past for a tough year, and they said this is the moment to use it. So they decided not just to maintain the dividend, they actually decided, because they were confident about the future, to increase the dividend in May 2020, even as the revenue fell. And so that's one of the reasons the trust has an unbroken growth record in terms of dividends, is because the trust has the ability to look through times of uncertainty. So what we've seen subsequently is the revenue per share has come through strongly. Ultimately, the dividend growth is related to the revenue per share. We've got to grow that income from the portfolio on a regular basis. I can't say whether that's going to be 3 or 5 or 7%. It'll be what it is. But most particularly, we'd like to think there's a premium to most other trusts. And certainly when you go back to, say, December 19, if you look at income coming from the FTSE 100, FTSE 250, if you look at the dividend, there's a dividend monitor issued by Computershare. Effectively, you see that actually income across the UK stock market is down, and the income from this trust has continued to grow. So again, that's just demonstrating the ability of us to generate premium income growth relative to the market.
Okay, thank you. There is a question here which I'll just answer briefly in relation to why, if the trust hasn't grown its dividend since the trust has grown its dividend since launch, why isn't it on the AIC's list of next generation dividend heroes? I will need to check that point, but I believe it may be something to do with the period of time that the trust has been in existence. It's launched in 2011, and there are some trusts that have been around a lot longer than that. Gervase, I don't know.
That's right. I mean, I think dividend heroes are often 20 years or 25 years.
I think,
and we just haven't got to 20 or 25 years.
No, exactly.
But I think when we set ourselves alongside the dividend heroes, I think we look quite good.
Yes. Okay. Great.
Yeah.
All right. Let's just reading through the questions here. Given the market cap, current discount and yield, do you think Diverse offers potential investors a compelling investment case versus other UK equity income closed-end investment trusts? I think we've covered that to a greater
Well, yes, but it's a nice question.
Yes.
And yes, is the answer to that. I talked about being more upbeat about the UK than I have been the last 30 years. I talked about small companies which haven't started to recover, but we think share prices will recover, and even tiny amounts of cash will make a big difference on those and their valuations. And most particularly, it's a self-feeding cycle. As small companies' share prices start to recover, then they can raise capital, and in raising capital, they can invest in projects which enhance their growth even faster. So actually, if we are going into an unsettled world, if profit margins come under pressure because they're at very high levels, they come down. If we do find that quite a lot of zombies go bust, and it's these geopolitical events of all kinds out there, then actually not only will the strong get stronger, but many of the small companies have the opportunity to do transformational acquisitions. So their earnings growth may not just continue to be good relative to international comparatives, but most particularly, you could find that some of the small companies buying assets from the receiver for £1, albeit they have to put working capital in, could actually see earnings growth much higher than mainstream companies. As I said, I sort of touched on earlier, I think globalization's all been about bigness. I think going forward, it's all, I think small caps will have the advantage. And coming back to other open-ended closed-end investment companies, they tend to be really quite sort of concentrated in many of the mainstream companies. So they don't have the opportunity we have to invest in these younger businesses, which have the opportunity just occasionally to generate transformational returns.
Okay. And then just a couple of sort of stock-specific questions, or talking about stocks. So first of all, valuations so low. Do you see M&A likely to pick up? Any possible targets in the trust? Yeah,
we do. Actually, what's interesting is many of the companies we think, if you just leave them alone, we're worth a lot more than a takeover price.
Yeah.
So nearly all the companies we say, one of the things we do say quite please don't get taken over. And a lot of them are kind of saying, well, is the market working, and is it going to recover, and perhaps we've got uncertainty going forward. So we can understand why some worry about that. We have had quite a large number of takeovers in the portfolio. I can't remember which one. I can't remember one. We must have signed one for irrevocables. That's commitment to vote in favour, but hardly ever. We'd much rather actually the takeovers went away. But coming back to it, I mean, there's one this morning actually,
right?
Kenmare, which is a company which is involved in titanium dioxide. It's used in paint and all that kind of thing. It produces about 7% of the world's supply of it. It's a big company. It's on the coast of Africa, Mozambique. But most particularly, the share price is in our view unusually low. There is a potential takeover. It hasn't been firmed up at this stage. We have spoken to the company today. In a perfect world, it wouldn't get taken over. It's got a mine life of 100 years.
Right.
In fact, it's got so much under the bonnet, and we think titanium, paint's going to be used forever. So going back to it, we don't want it to take over. If it is taken over, at least there's plenty of others to invest in. So coming back to the takeovers, we'd much rather have the upside without the takeovers, but there will be inevitably some.
Yes. Okay. And then we've got a question about Savannah Energy, which has just been relisted after a period of suspension. You probably don't want to comment specifically on your intentions vis-a-vis the portfolio, but what's...
No. I mean, what's interesting about Savannah is it probably feels a bit uncomfortable because it's mainly a Nigerian company. It does have other assets in Africa. It's an energy company, but actually unusually compared with most other African-based energy companies, is that a lot of its revenues are guaranteed by the World Bank.
Right.
So in fact, Nigeria may or may not do well in future, but most particularly Savannah's well placed. It's been a bit disappointing because it's been trying to do a very major takeover, which has been suspended subject to that takeover, and that takeover hasn't occurred. In a way, it's taken too long, right? And we've pushed with other shareholders to say, not sure about the takeover anyway, but put that aside, get relisted, and we're very pleased to see it relisted. We think the valuation's very overlooked, but then we would say lots of other companies in our portfolio are very overlooked. And coming back to energy prices, I mean, maybe coming down or whatever, but within the context of portfolio, we like that diversity. So we're not about to get rid of all our energy stocks and that kind of thing, just because the energy price is coming down this week or whatever.
Okay. And just one other question in relation to defence. How are you positioned in vis-a-vis defence stocks? Do you have much exposure?
Yeah, it's interesting, isn't it? I mean, the UK is obviously quite a strong defence industry. Clearly, judging by what's happening in the world of politics, we're going to get more investment in that sector. Ultimately, we have had a share of space of BAE in the portfolio. Actually, we've taken most of the profits. It's fine. It's doing fine, but it's fine. Actually, interesting enough, we think that many of the other younger businesses will be better placed. Drones and some of the technology involved in the drones, we think it's going to be much more significant. And sort of new aeroplanes and new tanks, probably less so. They take too long, they're too expensive. So actually, we've got companies which are younger businesses coming through. So obviously the portfolio in the top holdings you'll notice concentric, right? Sorry, it's concurrent, I mean. Concurrent technology is a company which makes single board computers, which are just plugged in to all sorts of assets, defense assets. It's actually had a new management team 3 years ago. We are tremendously excited, irrespective of what's happening in defense expenditure, and the share price has already come up substantially in the last 3 years. Have we taken profits? We think the risk-reward ratio on this is still looking incredibly strong going forward, and we think that single-board computers, it just introduced a brand new computer board yesterday, which was twice as powerful as most of the competition. So the opportunity not just to get new orders, but to keep replacing older boards is just terrific. There are others in the portfolio, so yes, we do have exposure to that sector.
Okay, great. Well, I think we'll stop there with questions, and hopefully we can have another call soon and we can talk.
Absolutely. No,
a few more questions.
One thing I was going to mention, we just had our interim report out. So on here you'll see things like the number of weighting of the largest holdings coming down and such like. Obviously that's online. You can certainly have a look at it online. But specifically, actually, if you wanted a hard copy, just let us know. We'll send you a hard copy. It's interim report, quite a short document. Very happy to do that.
Okay, and just some closing comments.
Yeah, I mean, the trust itself has been going since 2011, which is quite a long period, obviously. Now it's nearly 14 years. Wonderful. In a way, we think that that's been a toughish period. The UK has not been a particularly attractive market, particularly since Brexit. We've had less interest in the UK, particularly in the last, say, 10 years. US small companies, UK small companies have been out of fashion as well. So generally, yes, the fund's done perfectly well. It's outperformed most of the competition, fine. That's with things not being terribly helpful. If we're lucky enough to find that actually, there is more interest in good and growing income as a strategy by institutional investors, UK outperforms. We find that actually the opportunity for small companies not just to succeed but get recognised and see the share prices up and use the market to accelerate growth going forward. If we get a bit of a tailwind,
yes,
we like to think that actually the opportunity for the fund to distinguish itself and differentiate itself from many of the competition, from many of the international funds, isn't just that we think, hopefully it'll do well, but actually we think if the UK outperforms and this small caps outperform the mainstream UK, and if this fund adds a bit of value along the way, then it could actually look, in terms of return, relatively attractive to many of your international strategies, not just the UK. I'm tremendously upbeat about that.
Thank you very much, Gervais. Thank you.
Perfect. Gervais, Claire, if I may just jump back in there. Thank you very much indeed for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the Diverse Income Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.